Welcome to Cooking the Books. I'm Frances Cook. This year has seen a spike in new investors. Since the first COVID-19 lockdown back in March, the Financial Markets Authority estimates 120,000 New Zealand investors have joined local online investing platforms. That's a seriously big jump for a small country like ours. For perspective, the big platforms Sharesies, InvestNow, and Hatch now have about 250,000 clients between them. My first reaction to this news is absolute happiness. More Kiwis taking control of their money and investing for their future is awesome. I hope that even more people join the investing journey in the future. But with so many new investors coming in at the same time, there is the potential for things to go wrong. No worries though, let's talk about that and make sure that Cooking the Books listeners are the ones ahead of the curve.
Newstalk ZB presents Cooking the Books with Frances Cook.
I'm joined now by Rob Everett, Financial Markets Authority CEO. Now, there's been this really big spike in new investors this year, not just a few new people, but thousands upon thousands of them. Why do you think that's happening?
Yeah, you see, I think it's driven by a bunch of things. If you think about COVID and the impact that that had on markets, you saw markets swinging wildly in a bunch of different directions. You saw a lot of people sat at home with not a lot to do. You've got very low interest rates, so people aren't getting much from their savings if they've got savings. And I think you've seen the development of technology that makes it much easier for people to do this on an iPhone or a tablet or a home computer. So I think when you add all of that together, this was already happening, but it just exploded during COVID and has kept going. So I think really that's what's driving it.
Yeah, and it's funny, right? Because I look at this, and as someone who has been rabbiting on about investing and what it can do for you for so long, I feel quite torn because in some ways this increase is wonderful news. More people investing for their future and taking control, awesome, really big fan of that. But there is also a reason for a note of caution, right?
Yeah, absolutely. I mean, there's positive and negatives. I mean, I'm like you. We worry a lot about how engaged people are with markets and investments. And I think in New Zealand, people are less engaged than in some other countries like the US and Australia. So for people to be more interested in our markets and the performance of our companies and to find cheaper and easier ways of doing it, that's great. So that's really good. But there are opportunities and risks. And I suppose as a regulator, we typically start with the risks. So maybe I'll lay out a few of those because there are some real pitfalls. First of all, a statement of the obvious maybe, but markets are very unpredictable and very complicated, and even the most sophisticated, investment banks and trading firms and hedge funds struggle to have the first clue what's going to happen in a few months' time. So that's something for everyone to remember. The other real issue is that what you tend to see with investors that are new to a product, if it goes really well first up, they chuck a lot more in, they chuck the kitchen sink at it. And you need to remember again, in markets, it can go up and it can go down. And you probably need to be very careful not to put money in you can't afford to lose. We've also seen the explosion of chat rooms and social media around investing, which the US has had for quite a while. It's quite new to New Zealand, I think. It's actually been quite hard until this point to find anyone talking about markets other than deep in the business pages of the newspapers and the online business magazines. So in some ways that's refreshing, but it also is a bit scary. But on the upside, right, it can be fun. My oldest boy is 16, just turned 16. So he and I have opened accounts on Sharesies. We're having a little bit of a play, not very much money, but just to see who can do better out of that. And it's a great way for me to teach him a bit about markets because he wasn't interested before. But now some of his mates are in and he thinks he can put everything into Tesla. So all of a sudden he's interested, and I'm slightly worried he's going to wipe the floor with me. But it is a good example that if you're putting in money that quite frankly you can afford to lose, actually you can learn a huge amount about how markets work and just have a bit of fun. So, there are risks and opportunities on both sides.
It's so funny with Tesla, isn't it? I think a few months ago, it was all the new investors were going for Air New Zealand, and now everyone seems to be going for Tesla. It's like there's whatever's the hot thing at the moment.
Yeah, and that's what markets are like, though. That's and that's what people need to learn. That you get real hot stocks that everyone's talking about, And as they get more and more expensive, obviously people should be more and more wary about piling in kind of quite late in the piece. And so, I joke about Tesla, and I suspect that's what he's going to do because he likes the whole idea. Actually, most investment advisors would probably say any stock that's at all-time highs and well beyond its average high over the last 52 weeks, you probably want to think twice. So we'll see who wins.
Yeah, and it's funny, right? Because I spend a lot of time on social media talking to people about money, and I'm a huge fan of talking about money. I think everyone should make it a normal topic of conversation. But with that said, in some of my travails on the internet, I see people talking about things very confidently and saying things that I know for a fact not to be true. And it's not that they're saying it with ill intent. There are some people with very good intent giving some very dodgy advice out there. I mean, does it worry you that we're seeing things like Instagram and YouTube, we're getting slightly dodgy advice out there?
Yeah. Well, absolutely, it does worry us. I mean, it plays into that broader issue about can you trust what you see on the internet? And, frankly, should half of what's on there really be on there? And we do worry too. I mean, I agree that most of what's in the chat rooms and the social media sites, particularly in relation to specific stocks, you should ignore. I mean, honestly, it may be well-intentioned, but it's probably not very well informed. And there certainly have been examples in other countries, and I'm sure there's been examples here that we haven't seen yet, of people deliberately sort of pumping up a stock online, a share online, and then waiting for the price to go up and then dumping it, the so-called pump and dump. So really, one really important piece of advice is by all means look at the chat rooms and look at the social media, but really don't allow yourself to be overly influenced by it. Most of the people on there aren't experts. If they were experts, they wouldn't be on a chat room talking about it. And do your research beyond that. If you really want to understand what you're investing in, there's plenty of places you can look other than chat rooms. And I would encourage people to really take the chat rooms and the social media with a heavy pinch of salt.
Yeah. And you mentioned before Sharesies, and I think Sharesies, Hatch, Invest Now, all really good, solid platforms that we've talked about on this podcast before. But of course, if they're being flooded with new investors who are taking a DIY approach, how much responsibility should those businesses be taking as well? And how can they look after these people?
Yeah, that's a good question. And we've talked to all of those platforms, and they were all set up with very noble intent of making investing more accessible, driving the cost down, getting away from the big brokers and fund managers and letting people actually invest relatively small amounts of money. So all of that's good, but I think they've all, particularly Sharesies probably, but all of them have been a bit surprised by their success. And obviously the COVID period has just exploded. I mean, the numbers at those platforms are through the roof. So I think they may have been a little bit surprised by that, but they all accept they have a responsibility to help people investing on their platforms know where they can look. Some of them are partnering with people like Mary Home and others to try and get some objective general investment advice that can help people who are interested in learning, so that they have a better idea of what they're doing, if that's what they want. If they just want to have fun, they can just have fun, and that's great. But if they're serious about it, those platforms, I think they do understand they're going to need to invest in helping. I mean, educate's a slightly patronizing word, but provide information for people who are interested in learning. They're making a lot of money. They're doing really well. They need to put some back.
Yeah, and I think we have seen as well with things like Sharesies does the weekly webinar, and Hatch, of course, has the Getting Started course. Is that the sort of stuff that you want to see more of?
Yeah, absolutely. And I think the NZX too, and also regulators like the FMA, we need to do more as that group of people investing this way grows. We need to make more stuff available and more easily available. So we need to think too in the modern era about videos and podcasts, whereas in the past we'd have written a very worthy 12-page guidance note that no one got past the first paragraph. And we still do that. So I think everyone needs to work together to provide that. And the platforms, obviously, they're the ones bringing the customers on. They're the ones who can see their trading patterns. They can see whether they're buying or selling and whether they're holding for the long term or in sort of trading, day trading, if you like. So they will have a better idea of the types of customers they've got and what their behavior is. So yeah, absolutely.
Yeah, and when you mentioned at the beginning about, COVID, we were in lockdown, many of us were bored, and of course, people got a bit of a fright around their money as well, I think, and wanted to take more ownership over their money. And all of that is great stuff. I mean, if this was a wake-up call for some people that hopefully didn't have too big of an impact, but just pushed them towards looking into new areas, awesome. I really hope that works for them. But I mean, do you think that with COVID continuing to drag on and with the markets continuing to go up and down, so some people are maybe hoping for a bargain, do you think we'll keep seeing these increases in investor numbers?
Yeah, it's hard to know, isn't it? I mean, if there's a massive correction, and let's face it, the markets that most of us are trying to invest in are globally driven, right? So it won't be something that we know or understand that will tip things over the edge. If there's a big correction, it'll be something in the US. It'll be US-China trade wars. It'll be some politician somewhere being assassinated or Brexit going horribly wrong. So there is a real risk we could still see a really big correction. So a lot of the people that have piled in, markets partly fueled by that actually, have just kept going up since the early drop in COVID. And so there are a few people who do need to remind themselves that that sharp drop that led to a lot of this online trading, that could happen again. And so it'll be interesting to see if the enthusiasm survives that. Personally, I think it's here to stay. I think the use of technology, I think the enthusiasm for people being able to do some of this themselves that you pointed to, I think the distrust increasingly of the big institutions, and the fact that those big institutions probably don't really want to deal with clients who are putting such small amounts of money in, sort of typically in these areas. So I think it's here to stay. I do worry a little bit what happens if there's another really severe correction. But I think over the longer term, this is what we're going to be dealing with.
Yeah. And I mean, if these people are listening to this, I mean, there's a lot of investors who have been around for a long time who listen to this podcast, but we also get a lot of new people, and welcome to those new listeners. Are there strategies and best practice things that these investors should keep in mind as they invest, particularly in an incredibly turbulent year like 2020?
Yeah, well, there are some reasonably standard sort of practices that people would advise you towards. I mean, as I say, if you're just going to have a bit of fun, then by all means have a bit of fun, but make sure you're not putting in money that you can't afford to lose. And in fact, that's really the first rule of investing is think hard about what you can afford to lose and really don't put any more than that in. So that's where I would start. I think if you're genuinely wanting to invest, so you're in this for the long term, even if you're going to start small, have a think about what you're trying to achieve and when. So how far off is your horizon? Are you thinking about retirement? Are you saving for something? Are you trying to buy a home? Think about what your goal is and how far off it is, and then work back from that. So take the long-term view, or at least take whatever length of view that is. I suppose the other obvious one would be diversify. I joke about my son sticking everything into Tesla, but that's a few $100. It's not gonna break him. It's generally a bad position to put everything into one stock, or even frankly into one sector or one geography. And that's why the managed funds have had and KiwiSaver have had such a good run, is because they diversify your risk across a bunch of companies and geographies and make sure that if one goes down, you don't lose everything. So that would be the other important one. And ideally, if you're really in it for the long term, drip feed your money in. So again, sticking everything you've got in on day one just risks that day two the markets collapse and you really feel you've made a terrible mistake. If you can afford to, probably the best way to invest is to put some money in weekly or monthly, let it go out of your account just as a matter of course, and then it averages out the roughs and the smooths of investing over time. And if you're in it for the long haul, that's probably the best way to do it.
Yeah, I've got to say, when I first started investing, very lucky at that point to already be talking to people like yourself who are in the sector. And so I took all of that great advice I was hearing and I went for an automatic payment after each payday. And that just meant that it went in automatically. And I went for some index funds across a few different countries. So that meant I was across actually thousands of companies between it. And that means, you're spreading your risk around. I mean, these things mean that you can invest very successfully with not too much thought into it. And it really is what the data supports, isn't it?
Yeah, it really is, and that's why the KiwiSaver has been successful in the last 10 years. It's why these really low cost funds that just track an index. So they just, the Vanguard funds, the BlackRock funds, they just, take an index like the NZX 50 and they just copy it, right? And so it costs them nothing to do. So the fees should be really low. And so you get that spread of investment at very low cost, and you don't have to do anything at that point. If that's what you want to do, you put money in and you sit and you watch it. And my advice to people is always, if you're investing for the long term, think about that as the bulk of what you're doing. But if you're going to get bored and you want to have a little fun, keep yourself a little pot that you can afford to lose, and see if you can do better than the fund managers. And if that means sticking it all on red, then stick it all on red and see what happens.
Yes, actually, there's a name for that, core satellite investing. We did an episode on that. Oh, I can't remember when, but a couple of months back. And if people are interested and they're listening, go back through the Cooking the Books archives and you'll see it in the title. It'll be core satellite something, something, something. But it's a great strategy for those who just can't help themselves and want to try something out a little bit. You get the safety and the proper investing. That's not the way I want to say it, but that's what I'm going to go for. You get the safer version of, and you also get to stay interested and having fun, which, I mean, this is all part of it, right? You do a little bit of both is fine.
Yeah, and you learn a lot through this stuff. I mean, when I first put some money into US internet stocks when they were 3 weeks from their peak and then crashed almost immediately, I learned a lot about chat rooms and research and offering documents and all of that stuff. And luckily I'd put in enough that I could afford to lose without ruining my life. But you learn a lot, and it's a fascinating area, and it starts to help you make sense of some of what you read in the business pages, some of what you hear is going on in the business world. And I would encourage people to have a look. It's much more accessible than it was. But as I say, take care. Don't put money in you can't afford to lose. And don't put money in just because someone in a chat room told you you're an idiot for missing out and that they've invested everything they own and they've become a millionaire, because it almost certainly is either untrue or they're just deluded.
Yes, exactly. And I mean, this is the great thing about the platforms we were mentioning earlier. You can these days put in $5 a pop just to learn by doing. And that is a very safe way to sort of get your feet wet, figure it out without putting everything on the line. One thing I would like to run by you, it was a question sent in by a listener, great question. And often when I talk to people about investing and I'll say, a really good way for people to start is with an index fund because you're diversified and it's low fee and all of that is really important. But of course, the listener messaged and said, well, if everyone goes for an index fund, could it create a bubble because you're all investing in similar things? So is that something that's a concern for you?
Yeah, it is. It's such a good question. The growth in the last 10 or 20 years of these index hugging funds that we talked about earlier, low cost, very simple, just track the index. That's been a great development in terms of bringing fees down and making it more accessible. But what it does mean is there's a huge pool of money basically just following whatever is in that index, irrespective of whether those companies are performing well, whether they're falling apart, whether they're only just in the index and actually there's something you should probably avoid. If you're not applying any science, the money just washes around the markets like that, and it potentially massively amplifies the ups and the downs, and it shovels money towards companies without actually thinking about whether they're any good or whether they're doing any good. If you think about some of the ESG stuff. Now, at the moment, I think there's just about an equilibrium between those that are balanced between that wall of money that just follows the indexes or the indices and the money that's actively invested by fund managers who are actually looking at the fundamentals of those companies and picking the winners and trying to avoid the losers. So at the moment, the experts will tell you they think the markets are reasonably balanced, but I have to say, I do worry, and a lot of people do worry, that increasingly investing is just going to become about whatever's in the top 100, the FTSE 100 or the S&P 500, the NZX 50, and you're either in or you're out. And if you're out, you're finished as a company. So It is a worry, but I think at the moment there is still enough people putting real thought and science into the investing that it's just keeping the balance right.
Yeah, it's an interesting one, right? Because I have thought about this as well. And cards on the table, everyone who listens to this podcast regularly knows I love index funds. I think they're great. So bias declared, I guess. But it's one of those things where you have to have a huge proportion of people in index funds. And there's still so many people who want to actively choose their investments, who are working with fund managers who think they can give them the edge and say, we can beat the market by doing this and that. And as long as there's still that relationship, it balances out. It's just if it would get out of whack. I mean, is there a sort of a benchmark for when we would think it's getting out of whack, or is it a bit more art than science?
Yeah, I think it's a bit more art than science, depending on what market you're in. I mean, the US has been really big in this for longer. And depending on what research you read, anywhere up to 50% of that market is now just following whatever the indices are. And certainly at the end of a month or a quarter, when some of those indices rebalance, they change the makeup of who's in the index. You can see the trade flows, following that, and that does worry me. But I don't think there's a specific number that you would hit that you would absolutely decide was inappropriate. I mean, in my head, anything over say 50 or 60% that's just passive, you start to worry about who's actually making the decisions. Why is that company in the top 100? Is it just in because it was in last year and as a result all the money is going there, or are there enough managers out there actually looking at it saying, yeah, that's a company with prospects, we think the share price will go up, we'll keep putting money in. So I don't think there's a clear line, but I don't know that we're far off that line, and I would think a lot of markets regulators around the world do worry, but it's hard to know what you can do to stop it, to be honest. Index funds are great, they are cheap, they're very simple. It's hard to know how you stop the growth of those funds. So yeah, it's a bit of a challenge, and I don't honestly know what the long-term answer needs to be. I think for now there's enough money in the active side of the industry that it's keeping the index funds kind of honest, if I can use that word.
Is it one of those things where as people go through the investing journey, of course, a lot of people will start out with index investing and give it a crack, and then they might feel like they have enough knowledge that they're willing to try active and go for new things? Is it one of those things where if there's so much money in index funds that after a while there does become an advantage in being an active investor and trying to beat the market because you've got first mover advantage, and that leads to the market rebalancing? Can we rely on that rebalance effect, do you think?
Yeah. Well, certainly for now, whether it's individual investors or it's fund managers, they are looking at some of those indices and saying, yeah, 80% of that makes sense, but I can do better with the other 20%. And so, they're partially active and partially passive. And that active element is enough usually to keep the index reasonably sensible, because it will pop companies in and out of the bottom of the index as active managers change their views on who's going to succeed and who isn't. So I think whether it's individuals making individual decisions about companies, or whether it's fund managers who are running a portfolio that may be mostly passive, but has a portion of it that's active, or a particular fund that's active, it's enough to balance it. But yeah, I agree. I mean, it's a little bit like what we were talking earlier. If you're an individual investor and you've got a whole bunch of ETFs, exchange traded funds, or index funds, once you've got some confidence, and if you've got enough in your pot, you might think about a little bit of your portfolio where you look for a much more active fund. You look for one that is actually a bit more bespoke, is a bit more niche, to an area that maybe you're interested in, or an area that you think is going to outperform everyone else. And that's, again, a nice way of balancing your own portfolio to make sure that you have a bit of fun in it, and also it provides an opportunity for that active management that is actually what makes it all tick.
Yeah. All right. Well, I'm going to try and sum up some of the wonderful things that you've said. So basically, hello, new investors, and welcome. We're very happy to see you here. But also some tips: maybe be very careful about where you get your information from. Make sure it's good information. Maybe start out with a little bit regularly. So maybe $5 after each payday or whatever you feel comfortable with, and make sure that you're spreading it around and getting it in lots of different places so that you're not just all in on one investment. Is that some of the core messages, do you think?
Yeah, I think it is. And I think if you get to the point where you've got quite a lot of money in your portfolio and you're beginning to wonder, whether it's outgrown you, get some financial advice. Get someone who gets paid to do this for a living to help you work out what the longer term goals might look at. And they're going to look at it against your KiwiSaver and what you might get in superannuation and the rest of it. So as I say, if you get to the nice position where you perhaps have got more in there than you thought, that's a good point where you should be thinking about getting some help.
Oh, absolutely. And so many financial advisors will give you the first session for free to see if you're a good fit and to see if, you work together well, you're okay with their fee structure. So you can go and talk to people very low stakes and make sure it's the right choice for you. Hey, thanks so much. That's Rob Everett from the FMA. Now, if you have questions or you just want to keep talking money outside of the podcast, do come and find me online. I'm on Facebook, Frances Cook Journalist, Twitter, Frances Cook, Instagram, Frances Cook NZ. Send me those money questions and I'll try to get them answered on a future podcast episode. You can also subscribe to Cooking the Books. We're pretty much everywhere, and that way you'll never miss an episode. Anywhere you find podcasts, including iHeartRadio, Spotify, and Apple Podcasts. If this episode was helpful for you, then do send it to a friend. We can all learn more about money together. Until next time, have a great day.